All right, good morning, everyone. My name is Ben McClavick. I'm an assistant portfolio manager here at AAM. I've been here for just about 6 years now, and I have the privilege of introducing our next session, which is our client panel. This gives you all a good opportunity to hear from your peers on how they're navigating the difficulties and opportunities in the insurance space. We have a great panel lined up, and I'll start with the introductions down to the right. We have Marie-Claude Durocher. She's a director and portfolio manager for IA Financial's asset management team. IA is one of Canada's largest life insurance companies based out of Montreal. We have Diefenthaler from RLI. They are in specialty lines insurance based out of Peoria, Illinois. We have Ricco from PEMCO. He is the chief financial officer there, and they are based out of Seattle. I should mention Aaron is also the chief financial officer at RLI. And this panel will be ran by AAM's very own chief investment officer, Tim Senechalle. And with that, I'll hand it over to Tim.
Thank you, Ben. Thank you, Ben. Can everybody hear me okay? All right, perfect. I have the good fortune of moderating this panel, which we brought back by popular demand. The feedback from prior conferences was overwhelming that you all like hearing from your peers. And I think what makes this panel unique, what makes this special, and what will be valuable is the different perspectives that MC, Aaron, and Steve bring, because they represent companies in different markets, different lines of business, and yet they're working through the same challenges in capital markets that we're all facing. So their perspectives will be a little bit different, but focused on the same types of topics. We're going to allocate some time at the end for your questions, but I'd love for this to be conversational. So if something sparks when a panelist gives an answer and you want to jump in and ask a question, just raise your hand and I'll do my best to get those in. We may hold it if it's better suited for a later time. But and Irby, if Aaron says something inaccurate, just feel free to jump in and correct him right on the spot. So I'll start things off with just a question for everybody, maybe as a way of letting them introduce their companies. And we'll start at the end, MC, with you and just run down the panel. Maybe share with us one defining characteristic of IA and sequentially for each of you of your investment strategy that might surprise members of our audience.
All right, tough question. Start. So I'll bring the Canadian perspective. So I is a life insurer mostly based in Quebec City in the French part of Canada, where I'm from, as you can tell by my name and my accent. And it expanded gradually through acquisition in the US, starting by the acquisition of the life insurer American Amicable in Waco in 2010. And hence the relationship with AAM. But all that to say that through the acquisitions, we've maintained a portfolio in the US that's strikingly different from what we have in Canada, because we've chosen to use the investment portfolio in the US as kind of like our plain vanilla and integrated in the ALM of our bigger Canadian portfolio. So all of our return-seeking assets are in the Canadian portfolio, as you know, since you manage our pretty vanilla portfolio for now.
No offense taken on the...
I mean, we're looking to spice things up. We'll add a lot of CLO and private debt, so looking forward to it.
Aaron, how about you?
Yeah, maybe I'll start with from a philosophical perspective, and I have to be careful because Rosemarie is in the front row over here, and I tell this story a lot when we're sitting in front of AM Best. And,
you're also my client.
Yeah. You know, we have a long history of strong underwriting performance at RLI, and so on the investment side of the house, one of our philosophies is to be rather unremarkable, and that is true as a public company, but also we don't want to get in front of our story as an underwriting company and our emphasis around that. And so we have tried to keep exposures in the portfolio not just plain vanilla, but fairly transparent. So that doesn't mean we can't be creative. We absolutely can. But we want to make sure constituencies like AM Best or our investor base or the analyst community that covers us fully understands what's in the portfolio, because eventually headlines will come up, and to the extent we can articulate what exposures we may have around those headline issues and how we're dealing with that rather than surprising people with a mark-to-market event around opaque structures, that's a good thing for us. So that's from a philosophical perspective. From a more tactical perspective, and a characteristic of our portfolio that may be unique is the fact we run 20 to 25% in public equities. Helpful to have strong financial performance around an underwriting track record that has stretched 30 years of combined ratios below 100, but also, at the foundations of RLI, our founder, Jerry Stevens, believed I really need 3 engines of earnings to grow book value over time, and that's the right foundation for an insurance company and its valuation. So A, price performance on the equity side and having a component there that has a meaningful impact. B, consistent investment income, and 3, the underwriting performance, as I mentioned. If all of those 3 things are working in concert, I can compound book value over time and hopefully raise the valuation of the company.
Steve, how about you?
Well, I'm just jealous of consistent underwriting earnings, so because nothing has been consistent with ours. I will say, I hope my voice hangs out. I think that cab ride from the airport just scared my voice right out of me or something, so I'm hoping it works. No, we're in Washington and Oregon, primarily Washington, $575 million in premium. The last 10 years have been a complete roller coaster ride from an underwriting perspective, from we're the worst year in 30 years to the best year in 30 since 77. So it's been a personal line, so auto, home, boat, umbrella. It's really been kind of up and down and challenging regulatory environment in Washington that we've kind of overcome. So I'm jealous of your consistent underwriting results. I would say our investment portfolio is pretty unremarkable also. Every time we start having dialogue about taking on more risk, we have one of those years where we're not ready to take on more risk, so we don't have anywhere near the equity percentage. We're roughly 10% in equities. So from an investment portfolio, we've always been pretty consistent and pretty conservative in our process of investment. And every time we start rethinking through the allocation mix of what we do, we tend to go up and down based on how that underwriting performance goes. So it's been kind of a roller coaster ride.
Great. Well, I wanted to center this discussion around 3 themes, and the first related to a few of the items Aaron mentioned, transparency and communicating with stakeholders, and I wanted to talk about those areas that we all spend a lot of our energy on: boards, rating agencies, analysts, et cetera. And MC, you've got a board member in the room, so I'm going to put you on the spot.
I have to be careful.
And start with you on that topic of board engagement. What investment-related topics is your board or the finance committee at IAA most focused on today?
Right. So in my role, my team and I, we present to the investment committee of IA Financial Group, so the big Canadian company. But we also have a board that's dedicated to the US subsidiaries. So it's 2 different approaches. First of all, the investment committee is obviously an hour just focused on the investments, as opposed to the board, where the investment is the first thing where we start. And we have 1 board member that's very in tune with the financial markets and our portfolios. But other than that, I believe the board members want to know the investment go well, but they're not. It's not the primary focus of their board, as the distinction between IC and BOD would go. So very different approaches. In terms of the investment committee, it's in our DNA, obviously as an insurer, but also in Canada, we're known to be the most conservative of the life insurers in our portfolio, and we're like so many things have happened. Like we've crossed the 16 billion, so the large cap threshold in Canada as a market cap. So our organization is growing tremendously. So now we're looking to transition our portfolio to be more in line with peers and a bit more aggressive or less conservative. That's on the Canadian side, so no worries for my board member in the room. But so in Canada, it's that emphasis. So we're looking at a bunch of asset classes that are really exciting and that 5 years ago me would never have thought was possible in the IA portfolio. Like we added direct lending and whatnot. So a big focus of the investment committee is on the new asset classes that we want to bring to the table because there's a lot of analysis before that happens. And at the board level in the US, I would say they are looking at, for example, we did an acquisition, Vericity, that closed in 2024, so a Chicago-based life insurer, eFinancial or maybe Fidelity Life for those who are familiar in the room. And we learned a lot through that acquisition in terms of what was in their portfolio, what we can do in our portfolio, because we always have to balance the requirement of IFRS 17 accounting reporting with the US statutory. And so through Vericity, we're able to learn and move our portfolio. So that was a good question at the last board where I shared what we've been working on, which is to lower the duration.
Great. Aaron, you've got a different business mix, different regulatory structure, US-based board. What issues are you hearing about that are of interest to them?
So I've been around RLI about 14 years, joined as CIO in 2012. We used to spend 90 minutes every quarter with our corporate board of directors at the Finance and Investment Committee, diving into the details of the portfolio. And today we spend somewhere around 20 minutes, 15 to 20 minutes on the portfolio. That committee has changed from finance and investment to finance and risk, and so ERM is part of that committee today. And that's not to take away from the important exposures that are in the portfolio, but I think we've done a better job in preparing our board in advance of those meetings with very transparent communications and reporting to the point where they are very comfortable and have a good understanding based on the thoroughness of that communication in advance of the meeting, and so we can concentrate on other things in that venue. On top of the fact that we've taken our subsidiary governance structure out of the continuous meeting structure of corporate public company board and peeled that off to an internal management-based board of directors at the insurance company level that really has a tendency to dive into more of the details around manager selection, details on relative performance, and those types of things. And we can keep a high-level discussion at the corporate board level, just that, very high level. We can talk about the macro influences on the portfolio, how we're positioning at a very high level, rather than getting into all the details. So, we've kind of worked on that over the course of 14 years, and it's taken a while. But I think we're in a very comfortable position today with the level of touch in two sets of boards that are really responsible for portfolio exposure.
Thanks. I want to hit on that regulatory side that came up a little bit, and Steve asked you a question about the uncertainty, our theme for this conference related to the regulatory framework. Big changes last year with principles-based bond definitions, continued discussion at the NAIC on oversight in various areas. Just curious with PEMCO, has anything passed or looking forward caused your team to rethink about how you're allocating capital on the asset side of the balance sheet?
After a 118 year, everything gets rethought of, right? So you have 118, your surplus ratio is dropping, you're worried about AM Best interpretation and the OIC coming in. So when we had that, yeah, we are, especially to deal with more BA assets and stuff like that. But big picture, I've been with PEMCO companies for over 35 years, and I would say we're having more dialogue around the investment portfolio than any time in our history. And a lot of it is, it's like push-pull. So in other words, whether it's the investment committee, so we have an investment committee with the lead directors on that, and then we have the board. One meeting a year is just focused on the investment portfolio. And part of their question is, we've got some new directors, so there's a lot of push on, are we too conservative? Especially over the last 5, 10 years with the equity markets doing so well. And we're into private credit and we got convertibles. But the other part of the question is, digging down is, what's AI's impact on the equities? Should we really be adding to private credit? So it's like, we need to be more aggressive, but we don't like the assets that you can be more aggressive in. And it's this circular dialogue around how to move and moving forward. So with the improved profitability, I think the AM Best issues are a lot smaller today. But I don't like it to have the AM Best or OICs kind of drive what our investment philosophy is. It's really tied more to our underwriting results and capital leverage ratios that should drive it. Hopefully we stay out of problem areas from a regulatory perspective.
Gotcha.
I walked around that issue, so hopefully.
Well, we were talking, and you mentioned a little bit kind of push-pull, and Aaron, you talked about headline investments. From that vantage point, how does your team weigh the benefit of continuing to own and invest in asset classes or issues that are in the headlines with the reporting burdens or the scrutiny that might come internally or externally from those exposures? How do you think about that? How does that play out down in Peoria?
Maybe I'll flip your question around a little bit. And I often ask our team, if we're going to engage a new asset class or a new allocation within our core portfolio, how much does that allocation move the needle at the end of the day in terms of expected return? And I think when you bring that lens to the table, you often get to this push-pull between level of comfort around something new, how big that potentially could be in total allocation, and if how big it can be ultimately doesn't really move your expected return on a total basis. You should really question whether all those other burdens are worth it at the end of the day. And maybe you want to just be more thoughtful about your core effort and engaging managers that are thoughtful about adding incremental exposure to the portfolio that in aggregate can maybe get to a similar stratosphere for total potential return rather than the getting to the asymmetric result of something that's going to take all of your attention to A, explain, B, track, C, report on, et cetera. And so that move the needle question is always in the back of my mind when new ideas come up.
Is that a gut check, or is that something that's quantified within your process? 2% or less in assets and this amount of delta on return?
It ultimately becomes a gut check more than anything else. But I think you have to get comfortable with something in that 5% range in order to really move the needle much. When you're talking about LP investments, let's just use that as an example, below 1% each, and you got 4 managers, 5 managers, 10 managers in a bucket that adds up to be a couple of percentage points, you really got to ask. Everybody around this room is running with a small team in-house. And ultimately, your team is responsible for those exposures. And eventually, there'll be an issue here or there. Do you want to be on the front lines of that issue or not? And so it comes down to gut and experience.
It's interesting. We have the completely opposite approach. It doesn't move. I think there's pros and cons to both. I really like your approach. It's more efficient, but we do a ton of work to do just a tiny drop, but because it's just a first step, because we're a big boat, you don't move the Titanic on a dime, and so we'll do a little drop, and then increasingly we have like a 10-year plan to get to where we need to be in an asset class. But there's a lot of that red tape you mentioned to get it going, but after that it's scalable. But different approaches.
Yep.
Steve, for a mutual, does that calculus look any different?
I think sometimes when the investment side reports to the CFO, you're weighing all the extra work of a new asset class. So from my perspective, if we're not going to do 5%, I don't want to waste the time.
Yeah.
So that's our lowest allocation, any one investment class.
Gotcha.
It's probably a lazy way to think about it more than anything else. But
No, but I think our IFRS 17 accounting perspective also changes that if we increase our core earnings by just a little bit, it will show quarterly in our financial statements, whereas you're looking at it from a total return perspective.
You get a little more leverage on
A little bit, right.
balance sheet too.
Yeah, very much so.
and it might be the mutual. If you think about it, we don't have any shareholders, so
Right.
I'm not too worried about what something looks like in a quarter or even. I can think a little, I don't have to worry so much about that constituency.
Right.
I want to pivot a little bit and talk liquidity, and that can show up in a couple of different forms on balance sheets. The lowest hanging fruit being optimizing operating cash and investments to take advantage of what today are higher prevailing rates than we endured for a long period of time. And MC, just interested in opening that theme with you. You've got a lot of moving parts with many operating entities. How does IA manage its operating cash balance and make determinations efficiently to deploy in term assets so that you can maximize return on assets?
Great question. I think Darla would be better positioned to answer this. But on the dealer services entities, we work closely with them on the cash needs and the cash balances because our objective is to increase duration so that there's less cash drag. Because right now we're very conservative and we're basically holding the cash back because of lack of visibility on demand. And in terms of the life companies, because there's 6 different companies, they can borrow from each other, so they're actually quite flexible in their cash management need. If need be, they call on the mothership, so at the Quebec City IA company for capital injections or whatnot. So we're pretty flexible. It's actually a great, I think it's seamlessly done on Darla's side, our CFO.
Steve, you may not have the full treasury department that exists up at IA and don't have a mothership or 6 operating companies to borrow
Swivel
between.
money. Mm-hmm.
Not to mention the lumpy claims of a personal lines carrier. How does that play out for PEMCO in terms of how much you hold in reserve versus how much you send to the investment account?
Historically, liquidity's been, in personal lines, you don't usually have huge organic claim volume. So it's all about, historically in Washington State, we don't have, we just had winter windstorm. And when you have a big storm, you're paying it out over 24 months. So your cash flow hits are pretty easy to manage. What's changed the game is wildfire. Because when there's a wildfire hit, you're writing very large checks, for us, large checks. You have 20 houses burned to the ground. The money's going out really, really fast. And I've not historically had to deal with that at all. That's really more of wasn't even a peril that got modeled until 5 years ago. So our liquidity strategy has changed drastically because we do need access to cash flow. So we use FHLBs out there. But it is not, really, you have consistent premium and usually pretty consistent payouts that we can project out those cash flows pretty easily. So it really comes down to just cats. And as to when do you have a pressure on cash flow or liquidity, which does make it easier to decide how much money to move from operating accounts into the investment accounts.
Understood.
Or to draw back, frankly, which it's more to do when you're losing money.
And is the FHLB facility there as rainy day money, just in case, or are you active in using that to support the occasional unanticipated expense?
It's typically rainy day, although we're evaluating whether we should be a little more aggressive with our cash flow over time. But no, it's historically, we have a large line of credit there that we utilize for those big outplays.
Aaron, you're active at the Federal Home Loan Bank, as recently as this morning on their panel. Have you made any changes at RLI with regard to your facilities there, or as a part of that committee, do you see any trends emerging with insurers and the way they access the home loan bank system?
Well, I think there's a subset of insurers, mainly in the life space, that are active in a spread lending program, with FHLB being the source of capital to invest in things like structured products. There's less uptake there on the P&C side, partly because of the leverage profile differences between the two industries. So that trend has been in play for a long time, and FHLB would love for more people to come to that story and realize that they are a resource in that regard. I think it does take a fair amount of education at your board level and management level to understand the ins and outs and maybe the mismatch of either duration, credit, et cetera, between where you're borrowing and where you're investing those funds. We have taken FHLB as a resource over our 10-plus year history with them as a backstop, liquidity mismatch support mechanism, a support mechanism in catastrophe scenarios as well. They're part of the modeling of resources available should we get to a large outsized cat event that we have to stand in front of reinsurer capital and provide liquidity to our policyholders in an acute event before we receive payments back from them. We too model out reinsurer insolvencies, which would be a difficult thing to navigate, and so we think very long and hard about the reinsurance partners that we take on as part of our capital structure. But we also have gotten to the point where we're supplementing other longer-term borrowing facilities with FHLB as a resource. And we added to our financial leverage profile back in the 2021 timeframe because our financial leverage had gotten to a pretty low point based on balance sheet growth, and we viewed that as a flexible resource to dial in the financial leverage that we thought was appropriate for us. And so we're using it in a number of ways, some theoretical and some real, but the flexibility afforded by that organization and the efficiency of the funds that come the cost of capital efficiency of those funds is a real benefit to us.
Thanks. And Aaron, maybe a follow-up, and on the opposite end of liquidity is illiquidity. And low liquidity assets are gaining traction in our industry. Illiquid sectors certainly more prevalent for insurers than they were a decade ago. Where does RLI draw the line on the illiquid portion of your investment portfolio? Overall exposure maybe, and then segments where you just say, hey, I'm not going to do more than this in this bucket.
Well, I think from an ERM perspective, as you evaluate the liquidity necessary for those acute scenarios, you have to draw on the portfolio, most likely in those modeling exercises. So to the extent you have liquid assets, including a sizable public equity portfolio, which is extremely liquid, you may not like the price, but you can sell it if you want to. There's an aspect there that if you got to a certain level of liquid assets in the portfolio, you'll likely degrade the available asset that's around to supply those needs. I would almost turn it around to our outside manager partners to say, not just how illiquid do you want to be, but how off benchmark do you want to be in your portfolio. So we have a public bond benchmark structure that when you get into the illiquid space and those illiquid assets are embedded in a core effort, you're taking on non-benchmark exposure. So those answers have come in the 25 to 35% range of most portfolios. And so this is one of these things that it's important to have active dialogues around these potential operational challenges with your outside managers well in advance of an issue showing up, so that you're both at least on the same playing field around dealing with an issue.
MC, the cash flow needs of a life co are a bit more predictable than for these two guys here.
But the capital requirements, sorry to cut you off, but the capital requirements for liquid assets are really, really high. So the capital adjusted requirement for return are very different. So that changes where you allocate your marbles in your asset allocation. So we've done that because even the dealer services are regulated under the umbrella life insurance company. Sorry, but what was your question?
So is it fair to say that the regulatory regime is really the driver of how your company is thinking about where to move and how much liquidity risk to take?
It's taken into consideration at every. But that being said, we are moving to more liquid assets than we've had. Again, compared to peers, we were significantly underweight in those asset classes that are illiquid in nature, but we're gradually, very gradually, slowly moving the needle.
Okay, great. The third and last area that I was hoping to cover was more opportunities and risks and perspectives from these three on where you're seeing value and where you're feeling a bit more cautious. And Steve, I'd like to start with you on that. Where's PEMCO adding risk today with investments, if at all? And where are you all maybe pulling back a little bit?
I told you we have a lot of ups and downs in underwriting, and we're in an upside right now. So a lot of it's about getting a little bit more aggressive in the investment portfolio. So from a benchmarking perspective, when you look at personal lines business, we're kind of low on the equity side, private credit side. So expanding in some of those spaces is more the dialogue. The equity side is, again, part of that. It's really hard when it's a pretty impact AI. Is this the time to be jumping into more S&P 500, the Magnificent Seven? On the other hand, we're having dialogue that we need to move more into that asset class. So it's really a push and a pull right now to look into expanding and really get more in line with, I'd say, our peers are from an allocation perspective. But we're not looking at any new allocations. I would say in new asset classes, our focus is more on shifting allocations between bond portfolio, equity, private credit. We're not really looking into any more private real estate. It's been a pretty challenging space.
Got it. Aaron, you mentioned a healthy equity allocation at the outset of this session. And with the concentration topic that came up earlier with the hyperscaler, both on the debt and equity side, debt more recently being kind of a bigger part of the market, I'm interested in knowing how you all think about diversification kind of core values in a world where concentration risk is growing. Do you have a hard line where you'd say, hey, this S&P 500 fund now has too much exposure to these 5 stocks, so we're just going to cut pieces of it off and spread it around a little more? How do you deal with that?
Well, I'd much rather be on the passive side of the choice in how to access public equity risk in answering that question versus the active side where a manager actually is taking positions in those individual companies at that level of the index or beyond. And that's exactly how we've approached public equities, from a passive approach. And so everybody's well aware of the concentration that are in the passive indices because it's in the Wall Street Journal every day, just about. And so if you're moving with the market around a passive approach, you don't have the same active choice that you would with an outside manager at the same level of position that you're talking about. So it's less of a concern for me. I do think we do a great job of keeping exposure is very granular on the active fixed income side, however. And I would say our largest position is to an issuer is probably 0.5% of that portfolio. And there you are in an active stance, and there you do have headline risk that calls on the credibility not only of the manager, but you as the internal manager of that portfolio. And I think that's very important to stay in front of idiosyncratic risk in active situations, especially in fixed income for us, by maintaining that granularity in the fixed income portfolio.
MC at IA, is your team leaning into any new risks on the asset side?
Yeah,
You
I mean,
mentioned getting more aggressive. Where are you pursuing
slowly
that?
more aggressive. And again,
It's a 10-year horizon.
exactly. So we're not moving the needle just yet, but direct lending was our first private credit. Well, we have a huge book of private debt, but strictly investment grade. So very, very high quality. But direct lending is lower on the quality spectrum, although we're more the mid-market high quality. We're looking at high yield infrastructure private debt. So that's very niche, but we think there's a great fit with our ALM profile. And we have a strong private debt team and a strong infrastructure team, so it only made sense to double down there and that where those markets intersect. And yeah, that's the public CLOs in the US, eventually CMOs.
And maybe just to pivot on that, with benchmark yields kind of back up at competitive levels, and I think Pete's going to regale us tomorrow with tales from the equity market and his views on what we may see going forward. You know, a 5 to 6% yield, depending on risks in fixed income, is competitive. I'm interested from your seat if higher for longer in the bond market has prompted any kind of a rethink on duration or asset mix at IA.
No, the short answer is, and I love to quote Ray Dalio, the one who lives by the crystal ball will eat shattered glass. So we're not trying to predict too much because no one has the answer. We're not in control geopolitically at all the external shocks that we've discussed this morning. So we're focusing on our core long-term expected return assumptions. We're focusing on our ultimate benchmarks, which are our liabilities, so our portfolio of policies that we have, and so sticking to the long term and staying disciplined.
Steve and Aaron, you two have maybe a little bit more flexibility with your assets on the fixed income side. Are either of your companies doing anything different with duration posture in fixed income to lock in book yield at these levels?
No, I mean, you know, as rates rose in 2022, we probably shortened by half a year to 3/4 of a year. But that's a pretty big move for us, and we've been historically in the high 4s to 5 years of duration, which is long for P&C company. But you got to remember, you know, I got a liability structure on the balance sheet, but I also have fixed income assets that are surplus facing as well. So you can take a longer duration stance with those. So you get to a higher than average overall duration in that high 4 to 5 range. So you know, we have a tendency to stay pretty close to that target over time. To the extent that yields stay higher for longer, I think the one thing that may change is just the steepness of the curve. We've seen that thus far, and so maybe you move from a more balanced approach across the curve to something that what I would call is more traditional, casting that next marginal dollar out the curve. 10-year corporates, for example, letting those roll down over time versus being agnostic as to where you're playing on the curve.
We completely redid our investment policy and allocation 5 years ago. We're just now starting to have a debate, should any of that change? So we've really been pretty consistent in that process, other than the investment portfolio was shrinking, and now it's climbing quite a bit as to where we put it, so we've not made any material changes.
Understood. Well, I know that we are, the four of us are standing in the way of you all and your lunch. So we've got a few more minutes, and I want to make sure that I open up this forum for your questions. Those are highly valued, so I'll take a pause. We got one right here.
Yeah. Just out of curiosity, I imagine most of the insurers in this room are not tied to an asset manager or a private equity firm. But I'm curious as to how you guys, when you're selecting managers, put weight on the managers that are tied to an insurance balance sheet, whether that's private credit and real estate. Does that impact your decision or analysis at all when looking at a manager?
I would say you just have to ask tougher questions of that manager around how they commingle assets or how the strategies are commingled in some way, especially around the allocation of new issue is a great example. You know, how are they allocating to their own balance sheet versus outside third-party money? You just have to have some level of operational detail that you may get into is unnecessary with an independent manager.
Tougher and longer due diligence would be in the same
Yes,
vein.
same category.
Most of them have written policies that they can, and then you can dig through and find some inconsistencies, if any, or challenge some specific points. But in the few that I've seen, it was clearly stated.
Probably need a read on, you know, how independent is the third-party management team versus the internal team? Are they together, apart? You know, all of that, you get a read on just going through your regular due diligence process. So often this is simply sitting across the table from a potential partner and getting a level of comfort around that potential relationship. There's a lot of intangibles here that you can glean from just getting together in person, I think. Yep.
Other questions? Marilyn?
How important is total return, especially in your fixed income portfolio, or if that's your major allocation across the board? Do you measure it? How impactful is it? And then your board of directors come to the table and it's not good enough? How do you do it?
I suspect the answer to that question may differ across this panel. And Steve, I'd love to hear your thoughts on how you look at total return in your bond portfolio, and then maybe we can work down the table on that just to see if there are different flavors.
Yeah, it's a dialogue within the investment committee, but it doesn't, as a mutual, it doesn't drive a huge percentage of what we're at. So it doesn't have a big impact on how we decide what our allocation is from a total return perspective.
I think it's an easy metric for a board to understand relative performance to a benchmark, but I think it takes a long time for someone walking into that board seat to understand what total return means for an insurance company, especially someone that comes in to that board seat from outside the industry, because income is so important to an insurer. And for a public company, it's really important for operating earnings and consistency or increases to operating earnings, that you have to have a two-sided conversation around what are the drivers of total return over longer periods of time, often income, and how are you approaching the consistency around that income profile, and what are the trade-offs that maybe result in a total return profile that is different than a benchmark. Let's just put it that way.
At IA, I believe the board understands total return versus relative, and we do present those numbers quarterly. But there is a focus on IFRS 17, so the accounting results, meaning the core earnings and the market experience. So that's a big part of what we present quarterly in Canada and in the US. But I do believe the board member understand the trade-offs, all of them being in the insurance. Not all with an investment background, but at least understanding the basics of a fixed income portfolio.
Well, I have two questions to wrap up. And the first is, related to investment manager relationships and how you see those evolving. Steve, at PEMCO, the world's changing pretty quickly. How do you see the needs that you have on the investment side and what you lean on your investment partners for changing, if at all, over the next couple of years?
So we started converting to externally managed 10 years ago with AAM. 5 years ago, we brought in an advisor, completely changed our investment portfolio. So for me, especially been in a company a long time, and usually insurance companies use a lot of tenure, is being challenged to rethink those strategies and where we're really at, because you get kind of comfortable in where you're at. So after starting 10 years ago and new investment advisor 5 years ago is really challenging the executive team who are responsible for this to continue to improve and migrate, I think, the strategy. I think we're at the stage right now, given our profitability and everything, to kind of be pressured to reevaluate. And even our lead directors, like, are we really getting their opinion, or are they telling us what we want to hear? So having a harder dialogue about how we're managing the portfolio, where we're allocating those dollars, how we use liquidity, are we aggressive enough, really matters. The other part is just really being able to open and honest and talk with the advisor. So whether it's Marco up there, being having an honest dialogue about what we need and what we're looking for. I just think you do build a relationship over time.
Aaron, how about at RLI?
Well, I mean, I mentioned earlier, everybody's running with a pretty small team across the insurance landscape. And for RLI, there are two of us in the room today, which means nobody's at home minding the store at all. So hopefully everything's okay. I don't know, Irby, you're closer to the headlines maybe. So, you know, as we lean on outside partners, it's having someone at the table with you as just that, a partner, helping you think through issues that others in their client base are facing at the same time. Having that extension of your team is really important to us. And then you get to value-added services that could be on the reporting side, that could be risk modeling, that could be peer analysis, that could come in a number of flavors. And so that's what the investment results are very important, don't get me wrong. But the extras are as important, because everyone's running with a pretty lean resource situation internally. So,
on my end, I'm pretty humbled that I do live in Canada. So I'm far from, I love the US, I'm here every chance I get, but the reality is our investment team is based in Quebec City, Montreal, and Toronto. And so I'm looking for my investment manager for ideas, for what we don't have boots on the ground, what's in the market, from a new income and return generation idea, but also from a risk perspective. Like my board member had a question about FABN, and then it prompted me. Obviously, we know what it is and what it looks like, but I want your opinion on this. What does it mean? Is it realistic that it would be pari passu with policyholder or whatnot? This is just an anecdote, but I'm looking for ears and eyes in the U.S.
Top performing asset class in the next 12 months. What's your pick?
High yield junk bonds. No. I don't have an answer. Can I pass?
Should we let her
pass? You go, Aaron, and then I'll debate internally.
Aaron, you want to jump in?
Treasuries.
Wow. Bold pick.
Someone's going to ask where on the curve, and we'll leave that for dinner conversation.
That's a rough dinner. I hope they spare you that.
Short or long treasuries?
Steve?
Might be overly optimistic, but private credit.
Okay.
Okay.
Interesting.
I think I'll get on to private credit. A lot of negative headlines, very specific to software, generalized fear that is contagious to the real asset, the good quality assets.
So one bear and two contrarians in the room. I like it.
We're insurers.
Well, thank you so much for sharing your perspectives on these topics and providing a lot of great context for our audience. and for your partnership with our firm. We're grateful and just appreciate your time. So thank you. Thanks,
Thank you.
everybody.